Hello friends, welcome to the channel JIV and CIV Made Simple. Friends, in this lecture we are going to see CCP Certified Credit Professional, which is an IIBF certification course, previous year memory based question part 2 lecture. So these examinations are held frequently, and whatever question are asked in the examination, I am going to provide you question along with answer. This will help you in the examination to see which type of question are being asked. So let's start with the first question. First of all, you try it yourself and then see the explanation. So let's see the first question. So first question is related to the IPC, that is Insolvency and Bankruptcy Code. So the question is, under the Insolvency and Bankruptcy Code, which of the following is not a key component or authority involved in the resolution process? So you have been asked which is not a key component or authority involved in the resolution process. Let's go through the option. The first option say resolution professional. So let me give you a brief idea. So it is a central to IBC process. If we talk about this, in short we call it RP. So RP is the central to the IBC process. They manage the insolvency process. Not only manage, they coordinate between creditors and oversee the preparation of the resolution plan. So think of them as a project manager. You can think of them like a project manager, ensuring that all stakeholders are on the same page to resolve financial issue. Right, so they ensure that all the stakeholders are on the same page to resolve financial issue. That is called resolution professional. Second option we say information utility. Yes, correct. So the information utilities, you can think of them like a database, that store and authenticate financial information of debtor. So that stores and authenticate financial information of debtor that help in faster decision making. Right, so imagine a digital library that gives verified financial data instantly. You can imagine them like a digital library which gives verified financial data instantly. So this helps creditor and professional act swiftly. The third option say executive authority. So see, executive authority, if we talk about, so you know what NCLT is National Company Law Tribunal, and you know about this DRT, Debt Recovery Tribunal. So this NCLT and DRT act as the adjudicating authority. They approve or reject insolvency application and ensure fair proceeding. They are like judges in the courtroom, deciding whether a case qualifies for the resolution process or not. And the option D says interim resolution professional. So this is the incorrect option. There is no concept of interim resolution project in the IBC. Instead, the correct term is interim resolution professional. I think this no project, right? So this the correct answer is IRP, interim resolution. We can call it interim resolution professional, who temporarily manage the insolvency process until the resolution professional is appointed. So the correct answer is option number D. So what is the key takeaway from this particular question? First of all, we have seen the RP, which is the main person managing the insolvency resolution process. We have seen the information utility, a trusted source of financial data for quick decision. Then we have seen the executing authority, the body that oversees and approve the resolution process, right? So this thing. Now let's move on to the next question. Let's see what type of question are being asked in the examination. So question number 2, which of the following is appropriate in the project appraisal? Friends, if you are preparing for CCP, obviously you are preparing for CCP, then you can join our Telegram channel where you can find such type of questions. The link of Telegram channel is provided in the description section. So you will get exposure to what types of more questions are being asked in the examination. Okay, there are almost 500 people who have already joined the Telegram session, so you can take help of their experience also. Now let's see the next question, which of the following is inappropriate in the project appraisal? So the question is in which of the following is inappropriate in the project appraisal? The first is checking the borrower background. Option 2 says that verifying transaction check on a regular basis. Option 3, assessing the borrower's payment capacity, and option 4, evaluating cash flow for the project. So which is inappropriate? So let's see the first option, that is checking the borrower background. So this is the standard part of project appraisal. Lender need to assess the borrower credibility and past financial behavior to minimize the risk. So imagine you are lending money to a friend. Would not you want to ensure that they are trustworthy and have repaid debt in the past? So that is what this is a part of the project appraisal. Verifying transaction check on a regular basis. So this VTC, it is also called VTC, that is verifying transaction check on regular basis. See, this is inappropriate for project appraisal. While monitoring transaction is essential during project implementation, it is not part of the initial appraisal process. The focus of the appraisal is on feasibility. The focus on the appraisal is on feasibility, not day-to-day transaction. This is the main focus, not day-to-day transaction. Think of this as trying to monitor a project daily cash flow even before deciding to fund it. It does not make sense, right? The third option says assessing the borrower payment capacity, right? So what do you think about this? This is the crucial part. Understanding if the borrower can repay the loan ensures the lender's money is used wisely, right? Obviously borrower payment capacity plays a crucial role. And let's see the fourth option. So I can give you example to make option 3 more clear. It's like checking if someone can afford a loan before approving it. And option 4 says evaluating cash flow for the project. So this is the key part of project appraisal. Lender need to ensure that project can generate sufficient cash flow to repay the loan and sustain itself. It's like ensuring a business plan is profitable before investing it. So what is the correct answer? The correct answer is option number 2. So this is the correct answer, verifying transaction check on a regular basis, right? So what is the key takeaway from this particular question? So we have seen that checking the borrower background and payment capacity is essential to minimize lending risk. Evaluating cash flow ensure the project financial feasibility. And third thing we have seen, verifying transaction check is not a part of appraisal stage. It is relevant during the project implementation phase. Now let's move on to the next question. So let's see what is the next question that we have. As on now, how many core investment, I think CIC, credit investment company, this is not the correct full form. I think it is credit information company, right? CIC means credit information company. So let me correct it. How many credit information company have been declared by RBI at the domestic level? So at the domestic level, at the domestic level and at the international level, there are different types of CICs. So you have been asked to find how many CICs are there at the domestic level. So now the correct answer is 4. There are 4 CIC. Okay, let me name them. Let me provide you the name of them also. So you can see these are Credit Information Bureau Limited, that is called CIBIL. We call it CIBIL. CIBIL full form is Credit Information Bureau India Limited. And then after we have Equifax, right? Equifax. So Equifax Credit Information Service Private Limited. This is the second one, Equifax Credit Information Service Private Limited. First is CIBIL. The third is Experian Credit Information Company of India Private Limited. And the fourth is CRIF Highmark. So these are the 4 CICs in India, right? Credit Information Company. Now let's see the next question. Is ROC, you know what is ROC? ROC is Registrar of Company. Is ROC filing compulsory for LLP, that is Limited Liability Partnership? So the question is whether ROC filing, every partnership has to registered with ROC. So whether it is compulsory for LLP also or not. So let's see the option. The first option say no for unregistered LLP, it is not mandatory. See, this is wrong. There is no concept of unregistered LLP because an LLP must be registered under the Limited Liability Partnership Act 2008. You must remember it. This registration is mandatory. It's like saying you are part of a club without officially signing up. That does not work. Now, option 2 says that only bank consider ROC for LLP. This is also incorrect. While bank may check ROC filing for verifying an LLP compliance, registration with ROC is a statutory requirement under the LLP Act, not just for bank. Registration with ROC is compulsory for LLP. This is the correct one, right? See, filing with ROC is mandatory for LLP. It ensures legal recognition and compliance with regulation such as filing annual returns and financial statement. Imagine you are starting a business as an LLP. Without registering with ROC, your LLP cannot legally exist or operate. Option 4 says filing with ROC is optional for LLP. This is incorrect. Filing with ROC is not optional. It is a legal requirement for LLP to maintain their status and avoid penalty. So what is the correct answer? Option number 3 is the correct answer. So let me just summarize the key fact which we have covered just now. That registration with the Registrar of Company, that is ROC, is mandatory for all LLP under the Limited Liability Partnership Act 2008. Filing with ROC ensure that LLP is legally recognized and remain compliant with the statutory requirement like filing annual returns. Non-compliance can lead to penalties and legal issues for the LLP. Right. So this is about ROC and LLP condition. Now let's see the next question. A company has the following financial ratio. So this is a good question based on numerical part which have been asked in the examination. So you have been provided the financial ratios like current ratio given 1.5, quick ratio is given 1.2, inventory turnover ratio is given 6, current liability is given 1 lakh. You have to find the COGS. What is COGS? Cost of goods sold. So now let's first calculate step by step. So you know the current ratio. What is the formula of current ratio? It is nothing but current asset upon current liability. Okay, now see, it is given 1.5. So 1.5 will be how much? Current asset upon current liability, and current liability is 1 lakh. So you can say current asset will be how much? 1.5 times CL, or you can say 1.5 times 1 lakh. So this will be how much? 1,50,000. So this will be our current asset. Okay, now we know the current asset. Now let's move on to the quick ratio. Let's take help of this quick ratio. What is the formula of quick ratio? Let me write down here. That is nothing but quick asset upon current liability, and this is given 1.2. So 1.2 is equal to quick asset upon, and current liability is 1 lakh. Right. So how much will be the quick asset? So the QA will be 1.2 times 1 lakh. So this will be how much? 1,20,000. So quick asset is given 1,20,000, current asset is given 1,50,000. Okay, now what is the difference between the quick asset and the current asset? You know, see, quick under current asset also includes inventory. So you can say current asset is equal to inventory plus quick asset. Okay, so the difference is inventory. So can you tell me what will be the inventory value here? You can say inventory is equal to current asset minus quick asset. What is the current asset here? That is 1.5 lakh. And what is the quick asset here? 1.2 lakh. If we subtract, this will give you 30,000. So 30,000 will be the inventory. Now we know the inventory. Okay, and one ratio is also given, inventory turnover ratio. Let me erase it up. I think there is no space, so let me erase it and I will do the further calculation here. So what is inventory turnover ratio? Tell me, what is inventory turnover ratio? You know the formula? Let me remind you. I think you know the formula. Inventory turnover ratio, ITR, is equal to COGS upon inventory. This is simple formula, right? So we know ITR, inventory turnover ratio, is given to us 6. So in the place of ITR we will write 6. COGS we have to calculate, that is cost of goods sold, and we know the value of inventory, which is 30,000. So let me write here 30,000. So what is the COGS? So COGS is nothing but 30,000 multiplied by 6, which is 1,80,000. So I think there is no option here, but suppose there is a fifth option, that suppose there is a fifth option here, that is 1,80,000. So that would be the correct answer, right? 1,80,000. Okay, so hopefully you have understood this particular concept. Okay, inventory turnover ratio, how to calculate this COGS, this is how you have to go do it. Okay, now let's see the next part. What is the maximum period for which packing credit in Indian rupees can be extended to exporter as per RBI guideline? Friends, before going to the option, let me tell you that if you are looking for study material for CCP, in our app, that is JIV and CIV Made Simple app, you will find an exhaustive study material for CCP, in which we provide unit-wise theory, unit-wise MCQs, as well as previous year questions. All these things are available in the form of PDF, which is completely downloadable, and you can take print for offline reading also. So in the link beside in the description section, I have provided you the course link. You can directly go to the course and you can get each and every unit's theory portion, concise notes, complete MCQs, which will help you revise the concept. For more detail, you can WhatsApp me on this particular number also. Now let's see the next question. Question is, what is the maximum period for which PCIR, that is packing credit in Indian rupees, can be extended to exporter as per RBI guideline? Tell me, what is the maximum number of days? So PCIR can be extended to the exporter as per RBI guideline. What is the maximum number of maximum period? So options are 120, 180, 360 and 90. See, first of all, let's understand what is PCIR. Packing credit in Indian rupees. PCIR is a short-term pre-shipment credit. It is a type of pre-shipment credit. It is a type of pre-shipment credit provided to the exporter. It helps exporter finance activities like purchasing, processing, manufacturing or packing goods meant for export. If we talk about the duration, so RBI allowed packing credit for a maximum period of 180 days. For the maximum period of 180 days, this is allowed. Okay, from the date of disbursement. Date of disbursement to 180 days. Okay, if additional time is needed, bank can consider extension in exceptional case, but these may require RBI approval, compliance with a specific guideline. So the common duration is 180 days. Okay, now the second question is why duration is capped at 180 days. This time frame ensures that exporter have sufficient time to process good and ship them, right? It also aligns with typical export cycle, ensuring liquidity without overstanding credit. So extension beyond 180 days, there are some exception also. It's not hard and fast that only 180 days. Yeah, exception also there. Extension beyond 180 days are rare and subject to a strict regulation. Exporter must demonstrate valid reason. Like, let me give you an example to make this concept more clear. Imagine you are an exporter of textile. Okay, you are an exporter of textile. You take PCIR from the bank. You avail the packing credit exposure from the bank to purchase raw material and prepare the shipment. As per the rule, you need to complete your shipment process within 180 days to repay the loan, and if there is an unforeseen delay, you will need to apply for an extension through your bank, which will then follow RBI approval process. So what are the key takeaway from this particular question? We have seen what is the purpose of PCIR, that a short-term credit to help exporter with pre-shipment activity like purchasing and packing goods, and we have seen the maximum duration, which is 180 days from disbursement, and we have seen extension is also possible, right? So that is everything you need to know about PCIR. If you really find this explanation useful, give this video a like, share it with your fellow learners, and subscribe to the channel for more such insight. Let's continue to the next question. So let's see what is the next question here. The next question is as per the Tandon Committee recommendation, which method gives the highest MPVF? You know MPVF, maximum permissible bank finance. So there are some certain method, first method, second method, third method and fourth method. Okay, so which will give you the highest MPVF? So first of all, what is the Tandon Committee? Let me give you a glimpse. The Tandon Committee was set up to suggest way to regulate working capital financing by a bank. So main key factor is working capital financing by a bank. Okay, its main goal was to ensure that company use fund efficiently while reducing over dependence on bank credit. So that is about the Tandon Committee. The second thing is MPVF. What is this MPVF? MPVF refers to the maximum amount bank can lend to business for its working capital need. The maximum amount that bank can lend to the business for working capital need is called MPVF. This committee suggested three methods to calculate MPVF. So what is the first method? What does the first method says? Okay, you will get answer if you know these four methods. If you know what these four methods are, you will clearly get the answer. The first method says that bank finance 75% of the working capital gaps. WCG. What is WCG? This is the difference between the current asset and current liability, or the CLO say, which is nothing but current liability other than bank borrowing, right? So this is what, so 75% of the WCG will be provided by the bank and 25% will be provided by the it will be provided by the borrower, which is called borrower contribution, which is also called margin. So this is more restrictive because the borrower contribution is higher. What is the question asking? Question asking you to find which method give the highest MPVF. In which method bank will give the highest permissible finance. So it is not the correct answer. It is restrictive because borrower contribution is higher. Let's see the second method. In the second method, you know that borrower contribute 25% of the current asset and the bank finance the balance. So 25% of what? 25% of current asset. Since the borrower margin is fixed at 25%, the bank share increases. So that is why, as compared to the first method, in the second method we have higher MPVF, right? In this method we have higher MPVF. If we talk about the third method, so borrower contribute 25% of the core current asset, 25% of the CCA, core current asset. What is CCA? Maximum current asset required to operate a business. What is CCA? This is the maximum current asset required to operate the business. This is called CCA. Okay, so and the bank finance the remaining. This method is stricter as it focus on core asset only. So option D says all methods give the same MPF. This is incorrect. Now the correct answer is option number B. So the question is why the second method gives the highest MPVF? See, by we have fixed the borrower contribution to the 25% of total current asset. We have just fixed it in the second method. So the bank share increase. In this case, bank share will increase. Okay, and it allows for a larger loan compare as to the other method. So let me give you an example to explain it. Let's suppose company needs 1 lakh. Company needs 1 lakh for working capital. According to the first method, bank finance 75%, which is 75,000, and the borrower will finance the rest 25,000. Okay. According to the second method, borrower contribute only 25,000 and bank finance the remaining. Right. So in terms of margin and flexibility, second method result in higher MPVF. Okay, so that's the point. Now the next question is here it is. It has explanation is also there. In this way you will find explanation for each and every question. MCQ is also. Now the question is, who can initiate the CIRP? What is CIRP? Corporate Insolvency Resolution Process under the IBC Insolvency and Bankruptcy Code 2016. Who can initiate this CIRP under the IBC? Tell me. Options are only principal creditor, financial creditor and operational creditor, only operational creditor, all of the above. So first of all, what is CIRP? Okay, because we are dealing with CIRP, what is CIRP? So CIRP stands for Corporate Insolvency Resolution Process. It is a mechanism under the IBC to resolve case of corporate solvency. If we have to resolve cases of corporate solvency, corporate insolvency, in that case CIRP is used. So it is a legal process initiated when a company is unable to pay its debt and it aims to revive the company or liquidate its asset to repay the creditor. Okay, so this is about the CIRP. It is a legal process when the company is unable to pay its debt and its aim to revive the company or liquidate its asset to repay the creditor. Okay, so question is, who can initiate CIRP? Under the IBC 2016, the following entities can initiate CIRP. The first is FC. FC means financial creditor, a creditor who has provided a financial loan or credit to the corporate debtor. Okay, so for example, bank or financial institution who have provided loan to the to this particular debtor. Okay, so company is not able to paying its debt and it aims to revive the company or liquidate its asset to repay creditor. Now the first financial creditor. Second is operational creditor can also initiate CIRP. What is operational creditor? A creditor owed money for operational activity like unpaid supplies, vendor, service provider. For example, a logistic company unpaid for its service. This is example of operational creditor. And the third is corporate debtor. So the corporate debtor can also initiate the CIRP. Corporate debtor. So the company or debtor itself can voluntarily initiate CIRP if it is unable to pay its debt under the voluntary insolvency provision. This is typically done to seek legal protection and work toward resolution. So what about the principal debtor? The principal debtor cannot initiate CIRP on its own unless it is filing as a corporate debtor under voluntary insolvency provision. So let's suppose, let me give an example. Suppose there is a company named ABC Limited. It owes 5 crore to a bank. Okay, so this bank will be what? This bank will be financial creditor. Suppose it owes 50 lakh to a supplier. Okay, it owes 50 lakh to a supplier, so this supplier will be operational creditor. Suppose in this, let's consider the first scenario. The bank can initiate CIRP as the financial creditor due to unpaid loan. Scenario 2, this particular supplier can also initiate CIRP as an operational creditor due to non-payment of the dues. So this is OC, this is FC. Both of them can initiate CIRP, and this corporate debtor can also initiate the CIRP, right? But the principal debtor cannot initiate CIRP unless filing as a corporate debtor. So this process ensures transparency and fairness for all stakeholders involved. Now, so hopefully you have understood this particular concept. Now let's move on to the next question. The next question is, as you can see, yeah, this is a very good question. A company has sales of 24 lakh. I think, yeah, 24 lakh at 200 rupees per unit. The break even point is 50% of the sale and the profit volume ratio is 25%. You have to find the fixed cost. Okay, sales is given, break even point is given, profit volume ratio is given, and you have to find the fixed cost. So here you should know what is the formula for the profit volume ratio. This question is quite simple. You just have to substitute the value, right? You will get the answer. So what is given? Break even point is 50% of the sale. And how much is the sale? Sale is given 24 lakh. So can you tell me what will be the BEP? So BEP will be 50% of 24 lakh, isn't it? It's 50% of 24 lakh. What will be the 50% 24 lakh? 12 lakh. So BEP will be 12 lakh. Okay. And now PYV ratio is given how much? PYV ratio is given 25%, or we can say 0.25, either 25% or 0.25. Now first of all, you should know the basic formula to compute it. The formula is quite simple, that BEP, break even point, is equal to fixed cost upon PYV ratio. Okay, BEP is equal to fixed cost upon PYV ratio. So what is BEP? Let me give you how this formula came. Let me just remind you. So suppose this is our sales. One part of the sales is variable cost, you know very well, and the other part of the sales, this is called contribution, right? This is called contribution, right? And contribution, inside contribution you will get what? You will get two parts. One is the profit, and other is the fixed cost. So at at BEP, no profit is there, so contribution will be equal to fixed cost. You know it very well, right? At BEP, the point at which BEP held, there is no contribution, sorry, there is no profit. Okay, so our entire contribution will be borne by the fixed cost. So if we multiply this BEP with PYV ratio, this will give you contribution. That's how this formula came, right? Instead of this contribution, you can write BEP times PYV ratio. BEP is what? Number of units. It is nothing else but number of units, and PYV ratio means profit volume ratio. Okay, so this is how this formula came, and now you just have to substitute the value. Okay, you have to, so you can see here in this particular formula, you can see, you can write, just let me erase it. Okay, we have got BEP 12 lakh. Let me erase it, and I will do the calculation, risk calculation here. So so you have to find the FC, right? So FC, you can say it is nothing but BEP multiplied by PYV ratio, isn't it? So what is BEP here? BEP here is 12 lakh, and what is the PYV ratio? It is nothing but 0.25. So you can say 1/4. So what is the 1/4 of 12 lakh, right? So here it is 1/4, or you can say 1/4. I think it is 3 lakh, right? 1/4 is 3 lakh. So the correct answer is 3 lakh. So fixed cost is 3 lakh. Let me see the option which correspond to 3 lakh. So I think no option is given, but let's suppose option number E is there, 3 lakh. So 3 lakh is the correct answer. So let me again summarize the fact which we have learned in this particular question. Break even point is the level of sales at which there is no profit or loss. PYV show the contribution margin as a percentage of the sale. I already told you, it shows you the contribution margin, right? Contribution margin as a percentage of the sale. So that's why PYV, if you multiply with BEP, this will give you the contribution. And fixed cost calculation, use the BEP and PYV ratio, right, to find fixed cost when sales details are provided. So this is how you have to calculate this. Now let's see the next question that we have. The next question is, the limited liability partnership is established under which statute? So very good question. LLP question is regarding the LLP. So LLP is established under which statute? Options are Companies Act 2013. Yeah, this is wrong. See, first of all, if you know about limited liability partnership, so this is a unique business structure that combines the advantage of both a corporate structure and well as partnership. You know about it? It combines the advantage of both corporate structure as well as partnership, right? This is a unique feature of this LLP. So it offer limited liability to its partner, meaning their personal assets are protected. That is called limited liability. Okay, unlike in traditional partnership where the partners have unlimited liability. In traditional partnership, the partners have unlimited liability, while in the case of limited liability partnership, their assets are protected. The LLP Act 2008 governed the establishment, management and operation of the LLP in India. So the correct answer will be option number C. The next question is, why other options are incorrect? First option say Companies Act 2013. Say this act governed the incorporation and regulation and dissolution of company, not LLP. So Indian Partnership Act, this act deals with general partnership which does not provide a limited liability feature. And last is Society Registration Act. So this act pertained to the registration of society. So what is the key takeaway from this particular question? We have seen that LLP are governed by the Limited Liability Partnership Act 2008. It combined limited liability with the flexibility of a partnership structure. It is distinct from a company and traditional partnership. Hope that things clear up. Now let's see the next question. What is the green clause LC? Okay, the next question was asked, what is the green clause letter of credit? You have been provided with the four option. Okay. First option say, first of all, let me provide you explanation. A green clause LC is a specific type of LC that allows the exporter to receive advance payment for certain goods, certain cost before the shipment of the goods. Okay, so you will receive the advance payment means exporter. You will not. Exporter will receive the advance payment for certain goods. Okay, and the advance payment is specifically for storage and processing of goods. You will receive advance payment, but what it is for? It is for the storage plus processing of goods. Right, ensuring that exporter had necessary fund to take care of the goods before they are shipped in. This is particularly useful in scenarios where goods need to be stored or processed for significant time before shipment. It happens that in some product we have to store the goods, we have to process the goods for a significant time before shipping them, and for such cases this green clause LC is a superior, plays a fruitful role. Now let's see what are the other option. First option A say that LC that allow advance payment for storage and processing of goods, correct. And LC that restrict partial shipment, this is wrong, because this describe the red clause LC. You know about red clause LC, which can restrict partial shipment, not the green clause. An LC that mandate payment only after the final inspection of goods, so this is more aligned with the site letter of credit. Okay, and last option says NLC used exclusively for agriculture purpose. I think green clause LC not restricted to agriculture purpose. So what we have learned in this particular question, that the green clause letter of credit helps the exporter by providing advance payment for storing and processing goods. It reduces the financial risk for exporter, and this type of LC is highly beneficial in cases where goods require extra time for handling before delivery, right? So this is the key fact about the green clause letter of credit. Now let's see the next question. Which of the following best describe an English mortgage? So options are given. You can see four option is there. Option A says that the mortgagor transferred the property conditionally without any personal liability to repay the loan. Option B says that mortgagor bind himself personally to repay the mortgage money on a specific date, and the property is absolutely transferred to the mortgagee with a condition for reconveyance upon repayment. The mortgagor retained full ownership of the property but provide the mortgagee with a lien until repayment. Option D said that mortgagee has right to sell the property without transferring ownership during the loan term. So tell me which statement best describe English mortgage? So first thing, English mortgage is one of the traditional form of mortgage. It is unique in the fact that the first is mortgagor, right? So mortgagor means borrower. So borrower bind himself personally to repay the loan. Borrower binds personally to repay the loan, and the property is absolutely transferred to the mortgagee. Property is transferred to the mortgagee. Who is mortgagee? Mortgagee is lender. Property is transferred to the lender with a condition that property will be reconveyed to the mortgagor once the loan is repaid, and it involves full ownership transfer to the lender, but upon repayment the mortgagor get the property back, right? Now why are the other option incorrect? So let us go to the option. Option A said that the mortgagor transferred the property conditionally without any personal liability to repay the loan. So this describe a conditional sale. It describe a conditional sale, not an English mortgage. In an English mortgage, the mortgagor bind himself personally to repay the loan, right? Option B says that the mortgagor bind himself personally to repay the loan. Correct. On specified date, and the property is absolutely transferred to the mortgagee with the condition for reconveyance upon repayment. Yes, correct. This is exactly what English mortgage is all about. Option C says that the mortgagor retain full ownership of the property but provide the mortgagee with lien until repayment. What do you think? See, this is refers to the simple mortgage. See, it is quite essential to see each and every option because other option provide you a concept. So this is the concept of simple mortgage. So suppose question is what is simple mortgage? So this option will be correct. The mortgagor retain the full ownership of the property but provide a mortgagee with lien until repayment. Yes, correct. So in the English mortgage, the mortgagor transfer full ownership to the mortgagee, unlike in simple mortgage where only lien is provided. And last option say mortgagee has a right to sell the property without transferring ownership during the loan terms. So tell me whether it is English mortgage? No. This describes the power of sale clause. It describes the power of sale clause which is typically found in mortgage like the English mortgage, but it does not accurately describe the essence of the English mortgage. So the key feature is transfer of property with the condition of reconveyance. So let us quickly revise what we have learned in this particular question, that in English mortgage, the mortgagor transfer the property to the mortgagee and bind themselves personally to repay the loan, right? And upon repayment, the mortgagor can have the property reconveyed to them. The mortgagee has absolute ownership of the property until the debt is clear, right? So friends, as you can see, we have more 10 to 15 questions we have collected from the memory based from those students who have appeared in the examination. If you want such type of PDF, you can WhatsApp me on this particular number is shown on your screen, or you can join our CCP course. The course link is provided in the description. This course has helped many students clearing the CCP examination in a quite simple small framework of time. If you want any kind of detail, feel free to WhatsApp me on this particular number. Thank you.